Now, also, to build your cash value faster, you can get policies where you pay in a shorter period of time. So that's going to kind of like supercharge your cash value. But guess what else it's going to do? It's going to cost you more money. Those premiums are going to be higher. Now, when you have this whole life policy and it builds over time, when we talk about using it as a retirement asset or your bank meaning, okay, I'm going to borrow this money from myself. I'm going to maybe purchase an investment or an asset that's going to grow this money. And then when I make my money back from the investment, I'll put the principal back. The reason why when you create your own bank that you do want to probably pay your policy back is because it starts to charge interest every year that you pull a loan out. You don't have to pay it back. But if you don't, in the long run, the interest will keep building up and it will eat some more of your cash value. So always try to pay your interest back if you can, at least when you're able to. I would put that interest back at least if you're not going to put the principal back. When you put the principal back, it's like a line of credit because you're able to borrow the money, use the money, make money outside, put that principal back. Guess what? Borrow it again. Plus now it's grown to be a little bit higher than it was before. So now we have more of an option to take money out and do something else. That's really the creating your own bank. Now, some people say they want to use it to purchase their car, or some people want to use it to purchase a building. That's fine, but your policy has to have that amount of cash value in it. And for it to have that amount of cash value in it, most likely you need a larger policy. So for people thinking that, you know, their $25,000 or their $50,000 policy is going to get them to purchase houses, it's not going to be sufficient depending on how much that house costs or how much that car costs. So I just want to be realistic with you guys and have you guys have an understanding that the size policy you have does have something to do with how much cash value is going to be available in the policy. It's funny because I had a prospect that I spoke to and their goal was to purchase a home in 2 years, and they were like, I want to build $200,000. So in their head, they thought that if they brought a $200,000 death benefit, that they can borrow that $200,000 death benefit and have it for their house. So they were like, oh, I'm willing to pay, $250 a month. And I said, there's no $250 a month that's going to build you $200,000 in 2 years from this insurance policy. So I do want you guys to understand that the death benefit is not what you're borrowing. You're borrowing the available cash value that's built in the policy. All right. And that also goes into when we're talking about retirement and we're saying we're going to take out a tax-free retirement income, the cash value that's built into the policy, you can take it out on an annual basis or a monthly basis to give yourself an income. But the amount that's in there is based on what size policy you have. Now, because you're taking the income out each year, the policy is also growing as you're taking the money. So it's building more money, allowing you, more money to be able to take out over time. But the policy still needs to be sufficient to get you the income that you would like to have. All right. So that's whole life. And that's how it works with whole life. Let's talk